Alright guys, in this video I want to quickly talk about market structure. Now market structure, the reason why you need to know it is that it doesn't just apply only to forex. You can use it for any financial market, whether you trade crypto, you trade stocks, you trade futures, whatever you trade. Market structure is very important. So that's why as a trader you must understand market structure. In forex trading, market structure is simply the way price moves on a chart, or let me say generally, market structure is simply the way price moves on a chart, the framework that shows whether the market is going up, which is known as the bullish market, or down, which is known as the bearish market, or sideways, which is known as the ranging market. It is the foundation of price action trading, and every strategy is built on understanding it. So what I'm saying here is that every of your strategy, no matter how technical it is, it falls down to market structure. If you are analyzing the market, you are analyzing that to take a buy or to take a sell. So when you are taking a buy trade, you are actually aligning with a bullish market structure. When you're taking a sell trade, you are aligning with the bearish market structure. I don't know if you get me. So now there are key ideas you must know about market structure. The price moves in waves, making higher highs, higher lows, or lower highs or lower lows. So in a nutshell, price moves in waves, making highs and lows. By studying these highs and lows, you can tell the current trend and predict what might happen next in the market. So it helps you know the current trend, and it will help you to predict where the market is going to. Now there are different types of market structure. We have the bullish market structure. It is known as uptrend. Yes, the uptrend is made up of higher highs and higher lows. When we get to the chart, I will explain better. But I want you to understand that whenever you see the market creating higher highs and higher lows, the market is bullish. It means the buyers are in control. The same for the bearish structure, which is known as the downtrend. It creates lower lows and lower highs. It means sellers are in control. But for the sideways market, price moves between support and resistance with no clear trend. So whenever you see the market creating a sideways move, it means the market is not bullish, the market is not bearish. So you want to take note of your support and your resistance in the sideways market. Now, why market structure matters? It helps you spot the trend so you trade in the right direction. So if you don't understand market structure, you cannot trade in the right direction. So market structure is what makes you trade, or it's what helps you trade in the right direction. Do you understand that? Now, it tells you when the trend is changing, break of structure or change of character, we'll get there soon. It forms the base of smart money concept like break of structure, change of character, and other blocks, fair value gap, whatever you want to see, they all occurs as a result of market structure. They all occurs as a result of market structure. Now let's go straight to the chart. So I'll show you some certain things like what we have here. We have the bullish, we have the bearish, and we also have the ranging market structure. Now in this bullish market structure, you will see that the market is creating series of higher highs and higher lows. Let me write them out so you can see them on the chart. So you can see them. Let me write them out. Let me write them out here. Okay. Yeah. Let me write them out. Higher high. Let me put higher low here. Now, what we have here is a bullish market structure. Now, if you see the places that I mapped, this line here signifies that the market broke structure. It is called a break of structure. This one is also a break of structure. Now, for you to have a valid uptrend, you want to see the price breaking structure. You want to see the market breaking structure, like what we have here in the rechart. This is a break of structure. You see the market moving upwards, did a little retracement, and then boom to the up again. And right here we also have another break of structure here, and I think that's all for now. So right here we also have a break of structure. We have a break of structure. We just have them. So this is for the bearish market, although it's not quite a long trend, but we have a break of structure here. So that's the idea behind market structure. When you have a market structure being bullish, you want to see it creating higher highs and higher lows. The market moves in such a way that it identifies, or it literally explains the definition of market. A market is a place where you buy and sell. If you only have sellers in the market, that is not a complete market. If you only have buyers in the market, that is not a complete market. That is to tell you that buying does not make a market, neither does selling makes a market. Market is made up when you have buyers and sellers running the cycle. You understand? Buyers and you want to see buying and selling occurring before you can call it a marketplace, like what we have here. So this is the buying, then we have a retracement, which signifies selling, and boom, it broke structure to the upside because the buyers are in control. So the same thing for this bearish market here. We have the sellers, the buyers are retracing. Then what happened? We have a break of structure to the downside. All right, now in the market structure, there are two main moves that happen. We have the impulsive moves and the retracement move. The impulsive move is the move that actually creates the direction of the market, while the retracement is a move that completes the market structure of that market. Remember, market is a place where you buy and sell. Remember, market is a place where you buy and sell. So you want to see buying and selling occurring. Although you have a bullish market or you have a bearish market, but you want to see buying and selling occurring. But in a bullish scenario, the bulls will always be in power. That's why you will have a break of structure to the upside. And in the bearish scenario, the bears will always be in power. That's why you have a break of structure to the downside. While in a ranging market, you want to see market respecting your support and your resistance zone. Now, what's the support zone? This line at the bottom here is the support zone. You see, the price came down to this region. What happened? It went back to the top, to the resistance zone, and came down again to the support zone. So what makes it a support zone is that price is taking a reversal from that point to the upside, and what makes it a resistance zone is that price is taking a reversal from that point to the downside. Now you can also have your support becoming resistance and your resistance becoming support. What I mean is this. When you have a market like this and you have a breakout to the downside, this particular region can become a resistance zone for the next bullish move to return price down again. So it happens like that. So support can become resistance and resistance can become support. If this occurs to the upside, it can become support as well. So this is what market structure is all about. Now there are other things you need to know about market structure, but for the sake of this video, I'll be ending this here. You will stay tuned. I'll be dropping more videos on forex that will elevate you from being a losing trader to a profitable one. So what I mean by there are other things you must know, you need to know about market structure, is that there are two main forms of market structure. We have the external market structure and we have the internal market structure. So in my next video, I will explain what external market structure is and what internal market structure is. But for now, just know that a bullish market structure creates higher highs and higher lows, while a bearish market structure creates lower highs and lower lows. And lastly, before I end this particular video, I want to talk about something very, very essential, something very important. It is called a change of character or a market structure shift. Now, when you have a bearish market like this, you have the market, the price creating lower highs and lower lows. And what do we have here? We have a change of character. This is when the market break above the previous higher low, or rather the previous lower high of the downtrend to the upside. So what this is telling us is that the market is now about to take a trend to the upside. Now for the bullish market structure, it also occurs, but this time it occurs to the downside. It occurs to the downside, and you want to see markets continue the downtrend. So this is basically the idea of the market structure, and this is what we call the change of character. Some people call it market structure shift. They are both the same. So you see the market broke below this recent low to create a new lower low that's higher, that is lower than every other lower lows you have before. So let's see if that has occurred here. You can see this particular point, price has been creating higher highs and higher lows. We have a break of structure here. We also have another break of structure here. The market has been bullish, but when the market got to this point, it failed to break above this recent high, and what happened? Boom, it created a change of character in here. So this is a change of character. So what the market might intend to do next is to trade down to this point, is to trade maybe to this region, and boom, return down again, create another one, and you see, this is how the market intends to now operate. So this is why we call it a change of character. So that is very simple, guys. That's all about market structure and how it's being done. I'll see you in my next video where I'll talk about internal market structure. All right, guys, bye for now.